Welcome back to Stock Kong Invest and Analysis, where we look at the market and break down the opportunities.
Like and subscribe!
AI can't sustain this rate of return. Pause. This article was written by Joe Albano. AI technology holds vast potential, yet the industry struggles to convert adoption into profitable, scalable business models. AI-related services revenue in 2025 is projected at $25 billion, far below hyperscaler infrastructure spend, highlighting a critical financial disconnect. Enterprise AI adoption headlines overstate ground-level traction, with only 25% of initiatives delivering expected ROI. Retail and consumer AI is not helping either, as OpenAI now resorts to ads to supplement revenue growth. I am Joe Albano, a tech insider. I lead the investing group TechCash, which delivers my industry insider expertise to those looking for the best long-term picks, trades, and chart analysis of tech stocks. AI has run wild. Stocks are soaring, multi-billion-dollar investments are being made, infrastructure capex has never ever been higher, and private funding rounds are at levels the early internet days would blush at. But with a few years of investment and advancements in AI, why do we not see the revenue generation many have expected by now at end markets, not at the hardware level? When will the trillions of dollars start showing an ROI? Eventually, these investments will come home to roost, but whether that means success or failure remains unanswered. As of right now, it's not looking good. AI end markets are not pushing others out of the way, saying, "Take my money." Thus, I'll separate the technology from the financials in this article to understand how good technology can be a poor revenue center. While this article is about how AI is failing to turn into a viable business and actual profits, it's not because I'm against AI or the profits I'm making from the stocks involved. In fact, I've navigated the AI industry, calling out its beneficiaries like NVIDIA Corporation, NVDA, Arista Networks Inc., ANET, Micron Technology Inc., MU, and Meta Platforms Inc., META, before ChatGPT even came onto the scene. So when I say the AI economies have cooked themselves, I'm not hoping for it, nor am I oblivious to the forward potential, nor forgetting my fantastic calls on it. How it's been going. The AI retail and enterprise industry has not broken the glass revenue ceiling to this point. Will it? Maybe, but it remains to be seen. The trajectory has been, generally speaking, a solution searching for a problem. Enterprise level. You wouldn't think so, with headlines of enterprises adopting AI tools at a fast clip, according to many reports and research outlets. But the qualification of using AI is loose and headline clickbait. For example, a research firm wrote, "A bank deployed a coding assistant that boosted the productivity of tens of thousands of engineers by 10% to 20%. These efficiency gains meant engineers could focus on higher value projects in AI and data, rather than routine coding tasks." Coming from the development and software world, I can tell you there's no such thing as a routine coding task. These are non-technical industry buzzwords. Only non-devs use terms like this, because non-devs don't understand what a developer actually does. Neither do most executives, for that matter. MBAs don't write code. MBAs just see production revenue and expenses. If I don't have to pay as many developers and can replace them with AI, that saves us $2.5 million a year, goes the thought process. This is flawed thinking on many levels. Thinking there are routine coding tasks proves it. This leads to headlines of a lot of adoption for AI in enterprise businesses, but not a lot of traction on the ground level, as when you follow the money, it's just not there. The numbers are troubling coming out of 2025, as one analyst report highlights. AI-related services are expected to deliver only about $25 billion in revenue in 2025, roughly 10% of what hyperscalers are spending on infrastructure. That disconnect highlights a fundamental gap. Only about 25% of AI initiatives have delivered their expected ROI to date, and fewer than 20% have been scaled across entire enterprises. This doesn't mean adoption can't improve in 2026, and it very well may, but the spending on infrastructure is far outpacing the return. Even if these adoption numbers in enterprise double, it would still severely lag the investments to date and planned for 2026. Much of the problem is that enterprises, especially established ones, do not know how to integrate AI or worry about compromising their proprietary data. There's a lot of friction and a lot of pain points. As it turns out, many of these same employees asked to use AI at work find it frustrating because it's stripped of its usefulness by corporate oversight and limitations. They give up, yet they are users of AI in their personal lives. Many companies are also now regretting putting AI first and humans second this early, at least. It turns out Salesforce Incorporated, CRM, regrets firing 4,000 workers after replacing them with AI. This isn't the only story like this, and it's not likely to be the last. This places the enterprise adoption as not only lumpy and difficult to implement, but also going backwards in some cases. The problem is that enterprises are the hope for revenue generation, as there are more greenfield, higher per seat dollar opportunities. But if the enterprise can't produce meaningful traction, then it's up to consumers and the retail side. Can retail save the day? Not likely. The problem is getting the consumer to pay for AI at scale, and doing so for more than a convenience factor. Right now, many of the chatbots and LLM producers have a nominal subscription fee. But in the case of OpenAI, this isn't going to cut it if it wants to organically fund the hundreds of billions of dollars of investment in infrastructure it says it needs. Capital raises and funding rounds only produce one-time cash raises and dilute shareholders. OpenAI only survives if it can produce revenue and cash flow. The problem is that AI isn't selling itself. OpenAI is now looking toward ads within some of its tiers to enhance revenue. We're bringing Go to the US and everywhere ChatGPT is available, giving people expanded access to messaging, image creation, file uploads, and memory for $8 USD month. In the coming weeks, we're also planning to start testing ads in the US for the free and Go tiers, so more people can benefit from our tools with fewer usage limits or without having to pay. If this doesn't scream AI isn't attracting revenue, I don't know what does. OpenAI is already at the mature Netflix Inc., NFLX stage, trying to gain a revenue growth edge using ads, and we're talking similar price points. Building out an ad system costs money too, and is just another diversion of resources. Does AI not bring more value than Netflix? Clearly not. The overall numbers and the reading on the ground say AI isn't blasting through on an adoption level that the capital invested would indicate. There's a house of cards playing out in certain end markets of the AI world. The problem is, if a company like OpenAI fails, it takes down a lot of other companies with it. Many companies call OpenAI a customer, including NVIDIA and Microsoft Corporation, MSFT. This would be more like a domino effect rather than a quiet crumbling of a company. This isn't a setup for success long-term. Obviously, I recognize this is today's state, and it's not forever nor unchanging. AI will continue to improve and get better at its abilities and scaling. But how much longer can investments wait before the executive fiduciary duties are called into question? Is it another year, another quarter, another $1 trillion? Unless there's a breakthrough in AI capabilities in 2026, and friction can be eliminated to the point where enterprises have no reason to say no, there's going to be a continued widening of the gap between investments and returns. While I still see opportunities to find returns in the tech world, I'm leaning toward the current situation being more risky than it has ever been. Thus, I'm not placing nearly as much money toward the major companies like NVIDIA, Broadcom Inc., AVGO, and others. With the AI economics showing a hollowing out, I'm also looking at the sentiment angle. According to my charts, some may have already topped, while others have another leg to complete before they do. Overall, this is high-risk territory now, after almost 3.5 years of investments and stock rallies. This article was written by Joe Albano.
Hey viewers, like and subscribe to our channel. We'll keep bringing you more insightful stock analysis. It's going to be wild.